Good morning. Welcome everyone. It's Rebecca Patton, Head of IR at Hammerson, and welcome to our webinar this morning. I'm very pleased to be joined by Martin Summerscales, Head of Retail Consultancy at CBRE, and also Simon Betty, Director of Business Improvement here at Hammerson. I'll shortly hand over to Martin, who's going to present some of the key findings from this interesting report that we're working on with the IPF, and then over to Simon for some of his responses on how Hammerson is working as a retail landlord to respond to such trends in the multi-channel environment. After that, we'll be pleased to open up the line for your comments and questions. Excellent. Martin, over to you.
Thank you very much, Rebecca. Good morning, ladies and gentlemen. To reiterate Rebecca's comments, I'm delighted to be here this morning to share the outcomes of the piece of work that we have completed in conjunction with the IPF and Hammerson, which is entitled Pricing Retail Space, and aims to quantify the changing value of retail space from a pre-multi-channel world to a multi-channel world. This is an area of increasing focus as retail becomes an increasingly multi-channel pursuit, but to our knowledge it's an area that is currently rather qualitative, and we have aimed to quantify the impacts of the shift from pre-multi-channel to the multi-channel world. So in order to understand the context and the introduction of the shift, I'm just going to spend a few minutes talking around the shift to a multi-channel retail environment and the impact that that has had on the retail sector overall. As you can see from my first slide, which has the share of retail across different channels from the turn of the century projected forward to 2019, you can see from the dark green bar that the proportion of retail transacted in store has fallen pretty consistently from 99% in the year 2000 to around 89% today, and that decline is forecasted to continue for the next 5 years to 87% by 2019. And you can also see that the online only portion of retail increasing steadily, with the two shaded green bands in the middle showing the proportion of either sales that are paid for online and collected in store, or reserved online and paid for in store. So we can see that at a top level the importance of the store would appear to be diminishing. However, that really just looks at where the purchase is taking place, and if we delve a little bit deeper, we can see that actually there's an undercurrent of customer journeys that we need to understand in order to really fully value the role of the store. So what does that look like? Well, we've divided the customer journey into 5 different touch points: product discovery, trial and test, the purchase stage, delivery or pickup or fulfillment as it's often called, and then potentially a return. And we can see that this is a cycle in that if a retailer is giving the customer what they want, this often leads to further purchases and the customer journey starts again. So it's not just click and collect, it's click, collect, browse and buy. However, the data that's published at present around retail sales typically only really focuses on the purchase. Where is the purchase made, in order to attribute value to a different channel. So whereas we tend to focus very much on sales that are made either in-store or online, we can see from the pictures on this particular slide that the store is actually an important touch point at many different stages of the customer journey. And in order to break that down into a little bit more detail, we took a piece of research compiled by A.T. Kearney, and we can see that 35% of customer journeys remain single channel and only involve the store. So the red boxes on this diagram show that the store touches each part of the customer journey in 35% of customer visits. And similarly, online accounts for 10% of customer journeys in that it forms every touch point across the customer journey. However, as I've mentioned, retail is becoming increasingly and ever more multi-channel, and so the other 25 customer journeys are a combination of store-based touch points, which are shown by the red boxes here, and digital touch points, which are shown by the blue boxes. And they are now dominant. So multi-channel journeys, whereby online and the store work together, complementing one another, actually represent a greater proportion of customer journeys than single channel. And what we can also see from this diagram is that there are some columns where red dominates. So trial and test or return are areas where the store does a better job of fulfilling that customer touch point than does digital. And equally, there are other touch points such as discovery of products or fulfillment where it appears that digital performs a better job for the customer. So if we take the example of discovery, it's much easier for a customer to research products online, visit many different websites from the comfort of their living room. They can keep multiple tabs open. It's much, much easier to find information and compare products online than typically to do that in store. On the flip side, if we took trial and test, we can see that store dominates. And here it's intuitive, but being able to physically touch a product, see a product, hear a product, and measure a product in person is much easier in a physical store environment where you can actually get hands-on with the product than it is online. So we can see that there are many different customer journeys, but across the touch points there are dominances for either digital or store, but the vast majority involve the store at some stage. If we were to divide these into two broad camps, we can talk about web rooming versus showrooming. So web rooming are those journeys where the product makes it easier to research it online and then visit the store for fulfillment, whereas showrooming is the opposite, where it's easier to visit the store, to view the product, and then have fulfillment either by home delivery or click and collect. Now, whilst this relates to different customer journeys, it also really lends itself to different retail environments. So whereas web rooming would typically be smaller products such as fashion or footwear or jewellery, showrooming would much more relate to furniture, electricals and the like. How does this relate to the value attributed to retail property? Well, there's a big challenge for retailers in that it's very easy to attribute sales that are generated as a result of web rooming to the store because the purchase takes place in the store. However, when it comes to showrooming, it's much more difficult because the showroom may generate the interest in the sale, but it's very difficult then to attribute that to a sale on the website. However, if we've looked at some of the anecdotal evidence coming through from some retailers in this space, and Made.com, who are a very successful homewares retailer, they've opened a number of flagship showrooms, and they've reported that 5 to 6% of sales that they make online can be directly attributed back to their showrooms. And similarly, Simply Be and Jacamo also report a 5 to 6% uplift in sales on their website as a result of opening a new store. So the showroom effect definitely does have an impact on the online businesses of these retailers, and we've called that the online halo, that incremental benefit that retailers see as a result of opening a physical bricks and mortar store. And that's one of the things that we've aimed to build into our equation, which looks to price multi-channel era retail space. So without further ado, I'm just going to step into our research methodology. Now, as I mentioned, this is an area whereby in the past we've seen a lot of qualitative research but very little quantitative. And so the aim of our research was to quantify or aim to quantify the impact within a framework. In terms of research methodology, we spoke to some of the UK's largest multi-channel retailers to get their view as to how they're currently attributing sales between different channels. Just going to display a few of the responses that we got back from the retailers when we spoke to them. I won't read through each one in detail, but the flavour is that there's very, very little established methodology in terms of attributing sales from multi-channel purchases on a website to the store. And if I take the example of John Lewis, which is the department store retailer, they said that at the present time they're very much in the foothills of understanding this area. So even a retailer that's heralded as one of the most successful multi-channel retailers in the UK, very, very slick click and collect operations, even they're really at the beginning of the journey in terms of being able to really quantify what is the impact of opening stores on the overall sales picture for that retailer. So we've tried to quantify this, but clearly we're right at the very, very start of this in terms of a research journey, and so we may well be wrong. However, what we aim to do with our research is not necessarily provide the absolute right answer, but begin the debate and discussion around how this area could be researched in more detail, and also try to establish the direction of travel for retail property. So, in terms of our store productivity model, this is the framework that we've developed in order to try to quantify the change in productivity for retailers from the pre-multi-channel era to today's multi-channel era. So, in the days of pre-multi-channel, it was rather easy for retailers to quantify the benefit and the productivity of a physical store. You could forecast the in-store sales that you were likely to achieve from a store opening. You applied a profit margin to those sales, and then you subtracted a cannibalization or self-impact on existing stores within your network that would have been impacted by the opening of a new store. In a post or multi-channel world, we have to add in a number of different sales channels and centres. So we continue to have the in-store sales margin and cannibalisation, but we must also add in the impact of pure play competitors. So this is a new raft of competitors that did not exist before multi-channel retail took hold. In addition, we must also add in click and collect sales. Now these sales can be attributed to the store, so it's possible to add them to the quantifiable benefit of opening that specific unit, and again we apply a profit margin to those sales. And then thirdly, we also need to build in the incremental benefit to the online sales channel of opening that store. So we add in an online halo, but we also add in both an online margin, i.e. the margin on the additional sales that are generated through the retailer's website, but we also subtract what we've termed online leakage. And I'll just explain for just a moment what that is. So online leakage, if I take the example of Made.com, if my wife and I were to go to the Made.com showroom in Notting Hill and see a table or a sofa that we quite liked, and then we decide to go home and purchase it that evening, we can only really go to Made.com in order to purchase that product, because they sell unique items that are only available through their website. So they don't suffer an online leakage. It would be zero in that instance. However, if we then decide we want to head down to Currys.digital to purchase a television to accompany our new table and sofa, we can select a model that we quite like, we can measure it, if it fits, we can decide that we want to purchase it, but when we leave the store, if we decide to purchase online, as it's a stock product, there are a number of different retailers that we can go to get the product. And so some of the incremental benefit as a result of that store opening, the online halo, is lost to other retailers. So whereas we may have visited Currys.digital, we may well go to Amazon or AO World in order to purchase the product. So we've added in this online leakage to account for the fact that not all the sales generated by a showroom are actually retained by the retailer opening that showroom. I'd just like to talk through a couple of examples from different areas of the retail world in terms of product category and in terms of retail location. And I'm going to start with a fashion retailer, in this case Lululemon store in Covent Garden, in a prime city centre. So if we take the pre-multi-channel store productivity equation, we can suppose that a store of that nature may have taken sales of £10 million in the past, and if we apply an estimated margin of 45%, the gross profit from the store is £4.5 million. As Lululemon don't have any existing stores in the catchment area, we don't have to apply a self-impact, so they retain all of that gross profit, £4.5 million. In a multi-channel era, we calculate that space, the store in central London, is roughly 30% more valuable. It's 30% more productive. How have we calculated that? Well, if I walk through the green numbers, which show our multi-channel store productivity model for this example, sales in-store have increased by 20% from £10 million to £12 million. That's as a result of the shift from people shopping in local centres, maybe once a week. The multi-channel era has helped to usher in a greater focus on the more regionally dominant centres, as people can research in the comfort of their own homes and then shop less frequently, albeit spending more when they do, in the very best centres with the very best retail mixes. We apply the 45% margin as before. We subtract the same self-impact or cannibalisation as before, again in this case 0, and then we also subtract a £300,000 impact from pure play competitors. The next line down, we've added in the click and collect sales, let's suppose £800,000, and applied a margin to those sales. And then we've also added in the online halo, so that's the incremental sales that Lululemon in this case would receive from opening that store. We've applied a margin of 60%, and then the 15% online leakage, which we subtract, that's represented by the 0.85 decimal, represents those sales that may have gone to other yoga retailers online serving the catchment, but where the showroom helped to generate the interest in the yoga gear. So if we take the pre-multi-channel figure of £4.5 million, we've calculated a multi-channel or post-multi-channel figure of £5.846 million. The difference between the two is 30%. So we can estimate that the space in this example has got 30% more valuable as a result of the shift. Talking through a different example, just going to focus on a retail park location and a grocer. So this is completely different. And there's a few nuances with the grocery business in that the stores not only act as both a showroom and a retail store, but they also act as a fulfillment centre. So in many cases, the largest grocery stores of this type are actually used to pick orders in store, so we can directly attribute all of the sales in the catchment served by this store to the store, because there's that physical link. So walking through, in our pre-multi-channel productivity model, we can suppose a store of this nature would have sales of £50 million. We apply a gross margin of 34%, apply a £500,000 impact on the other grocery stores of this retailer in the catchment area, and that gives us a net productivity of £16.5 million. In the multi-channel era, as a result of changing shopping patterns, we can estimate that that space is roughly 8% less productive. How have we calculated that? Well, again, I'll just walk through the numbers briefly. Sales have dropped by £5 million to £45 million as a result of the move from people shopping in store to shopping online. We retain the £500,000 impact on neighbouring stores. We also add in £500,000 impact to pure play grocery retailers such as Ocado.com. We've added in click and collect sales to the tune of £500,000 and applied a margin to those sales. We've also added in £7 million of online home delivery sales. There is no leakage in this case because all of those sales can be attributed to the store as they are picked there. So the reduction factor is nothing, so we times it by 1. And then we apply a much lower margin to these home delivery sales to account for the additional cost of picking, packing and delivery that is not recouped by the delivery charge levied on the customer. So in total, the productivity of the store is around 8% less, whilst the sales at the store are actually 5% higher. So in total, sales have risen from £50 million to £52.5 million, but because of the changing margins of multi-channel retail in the grocery sector, the productivity of the space is much reduced. As I mentioned to begin with, we built a matrix of different retail environments. So we looked at prime city centres, secondary retail locations, retail parks and regional shopping centres, and we also focused on 6 different product categories, from fashion to catering to electricals to grocery. We also looked at discounters and health and beauty retailers. And in the matrix, which is on this slide, we can see from the traffic lights at the bottom of the screen and on the right of the screen that the locations that our research is suggesting have benefited from the shift from pre-multi-channel to multi-channel are the prime city centres and regional shopping centres, and it's secondary retail locations that have really suffered. And from a product category perspective, fashion, catering and discount retailers have benefited from the changing retail landscape brought about by multi-channel, whereas grocers and electrical retailers have seen the opposite effect, and it's been to their detriment. So what are the implications for property? I'm just going to take those 4 different segments of the property market, and I'm just briefly going to discuss some top-level implications for each of them. I'll start with the prime city centres. So as we can see in the top right-hand corner, we've got an example which is Oxford Street in London. We foresee that this area of the market will continue to strengthen, and we foresee that we will see fashion retailers in particular taking ever larger spaces in order that they can showroom and showcase more and more of their goods. We expect international retailers coming into the market really focusing their attention on the core retail centre of the UK. So whereas before you may have needed 200 retail locations to cover half the market, really our research now shows that you only need 75 or 80 retail locations as a result of this consolidation. We also think that the retail mix on key streets such as London's Oxford Street will become much more weighted towards fashion, footwear and jewellery, and retailers, even like the coffee shop operators, will be marginalised to either upper floors or more marginal secondary streets. In the example of secondary high streets, the picture in the top right hand corner of the slide, what we are not foretelling here is an end of these types of locations as retail destinations, but we do foresee the need for some consolidation. And I think the challenge for these types of centres is to reinvent themselves as not necessarily places where people want to go and shop, but more as places where people want to go. So retail uses may convert into budget gyms, civic uses, or maybe even healthcare or residential facilities. But there'll certainly be a requirement for a lower amount of space, and the space that does remain is likely to move away from comparison goods such as fashion, footwear and jewellery, and towards more convenience-led shopping and catering that people really don't transact over the internet. In terms of the retail park sector, whilst our research shows that the productivity from a sales perspective may have declined slightly in this sector, we still feel they've got a very, very significant part to play from a fulfilment perspective due to their accessibility, from a logistical perspective, helping retailers move goods quickly and shorten fulfilment times, and also from a customer experience perspective in terms of allowing retailers to showroom goods and then use the online halo that I've discussed to drive revenue through their online channel. And then finally, in the case of regional shopping centres, again, our research has really highlighted that this property asset is expected to benefit as a result of the shift to multi-channel. That's largely as a result of this consolidation of expenditure in the best centres and the practice of web rooming, which allows people to research goods online, find the products that they want, and then again visit the best centres in order to see the goods and purchase the goods. So in the same way as the prime city centres, we expect retail centres of a regional importance, such as your prime regional shopping centres, to go from strength to strength. And that concludes the presentation from me this morning. I'm just going to hand back to Rebecca.
Thanks so much, Martin. That's absolutely fascinating. Thanks so much for talking us through that piece of research you've been doing with the IPF. It's clear that the physical retail space is becoming an ever complicated area in the era of multi-channel. Simon, clearly for retailers, the leasing decisions becoming more sophisticated because of the halo effect, because of click and collect. How are your conversations that you're seeing with retailers and the leasing model adapting and Hammerson working with retailers to reflect some of these trends that Martin's highlighted?
Yeah, sure. Hi everyone. I mean, firstly, I think Martin's being a little modest about his model. I mean, he introduced it. We've done this. We've spoken to a few people about this, and he always introduces it and says, "Oh, I don't think it'll be right, but directionally we're quite confident about it." What's interesting is that the outcomes of the calculations almost exactly reflect what we're seeing on the ground. So prime city centres and regional shopping centres becoming more relevant and more valuable, I think that's well understood by the market. Neutral on retail parks, I think that's broadly consistent with our view as a market, albeit we feel very confident within that sector we can pick winning assets. And as you know, we steer clear of secondary retail locations for all of the reasons outlined in this research. And the same goes for product categories, fashion, catering and discounters doing particularly well, other sectors less so. So anecdotally, what we're seeing almost completely supports the outcomes of the model. In terms of some detail around the negotiations that we currently have with retailers and how it may support these findings, I mean, I think the first thing to say is that for most retailers, physical retail space is still highly profitable. The average return on capital employed for a basket of leading retailers, is close to 20% for new stores. So in the right location and with the right product, retailers still enjoy high profitability out of their physical locations. There's no question that it's dominated by fashion and catering. And I've just been doing some work this morning on our pipeline of leasing deals, and it won't surprise you that the majority of them, and particularly those that we're able to strike the best rental deals, are in the fashion and the catering sectors. For example, in Leicester, we recently let a retail unit to a catering operator at 3 times retail ERV. That same operator has taken a store in Reading at 2 times ERV. In Union Square, our ERVs have grown in the order of 30% since opening, driven predominantly by all the work we've been doing introducing leisure and catering there. And at Watermark, over the course of the development process, our rents are up by about 15%. Unfortunately, that project, rising construction costs have mitigated some of the profitability. But there is no question that the deals we're able to strike with catering operators are highly attractive to us and supports our strategy to take the retail portfolio to 15, 20, maybe even 25% to that sector over the course of the next few years. Similar story in fashion. A couple of interesting deals at Bullring, one to Pull & Bear, one to And Other Stories, both between 5 and 10% above ERV. But I can't tell you when we last did a deal with an electrical retailer. I mean, set aside Apple, they're a slightly special case. But, you know, the Jessops, the Currys, the Dixons, all these names that we used to see on the high street, for our portfolio have really lost their relevance. So I think when you think about our capital allocation towards big shopping centres, selectively into retail parks, increasingly into outlets and developments, away from the sorts of centres that this business used to own 10 to 15 years ago, when you think about the way we organise our property activity, such as leasing, asset management, tenant mix strategies, the introduction of the digital platforms that we're building, I think you can see that pretty much everything we do here is grounded in a view that there will be relative winners and relative losers in the retail space. And this research is particularly helpful and influential to us in enabling us to put a bit of science around what we qualitatively observe to be the case anyway.
Great, Simon. Perhaps at this point we can open up the forum to some questions on the line. I'll hand over to the moderator. Do we have any questions lined up?
Thank you. If you would like to ask a question at this time, please press star 1 on your telephone keypad. Please ensure that the mute function on your telephone is switched off to allow your signal to reach our equipment. Again, please press star 1 to ask a question. We will pause for just a moment to allow everyone to signal. We will now take our first question from Christopher Fremantle from Morgan Stanley. Please go ahead.
Hi, good morning. I thought it was a very interesting presentation. Thank you very much. And I appreciate you said that this was just an approach. I just want to, on the examples that you gave, just pin you down just slightly on the numbers that you were talking about, just so we can understand sort of how much of those numbers are estimates and how much of them are sort of how easy they are to back up. So, for example, on your Lululemon example, those figures in green, what numbers are quantifiable and what numbers are estimates in that example?
I think, thank you, Chris, for that question. I think in terms of the numbers that are quantifiable, in terms of, if we're talking about Lululemon specifically, I'd say that there are no numbers in there that we can definitively say are attributable to a store. Mm. But what we have done, from our knowledge of working with retailers such as this, is supposed upon a figure that they would likely turn over from a unit of this size in this location. So I think, to echo what Simon was saying, it's better to be roughly right than precisely wrong. And I think that what the research does show is that the movement in sales shows that this space has got significantly more productive. And these gross margins, could they look a little bit high? Could they, particularly on the online? Possibly. But if we move them, it's not going to really reflect the underlying theme of the research, which is that multi-channel has caused this shift in customer behaviour that has been to the benefit of locations such as this. In terms of the Tesco example, I used to work there, so I'm happy to talk through some of those figures if that would help. Yep. £45 million from a size a Tesco Extra would be not particularly demanding. 34%. I just estimated there that's the kind of gross margin on an in-store basket of goods. £500,000 cannibalisation would be completely dependent on the location of the unit. So if it's close to an area where you've already got many stores, then clearly it would be higher than if you're opening in some brand new territory. And then the hit to Ocado, we just looked at their existing market share. In terms of the click and collect sales and the online sales attributed to the store, I can confidently say that Tesco Extras up and down the land will see online sales at that level, and in the case of the click and collect, probably far in excess of the £500,000 that we attributed. And then in terms of the margins that we applied, the click and collect margin being 29% just reflects the increased cost of picking and packing, but clearly you don't have to take it to the customer's home. And then the 11% gross on the home delivery, again, that does bake in that additional delivery cost, and I'm comfortable that that's in the ballpark for that sales channel.
Okay. And is it your intention? I'm assuming the answer is no to this question, but is it your intention to, is it Hammerson's intention to start to try and make this approach part of the rental negotiation process, or is it purely is it too early to start thinking about that?
It's a good question, Chris. If I just comment quickly on your previous question, because one of the challenges with this piece of work that we've experienced since we started out on it is that retailers themselves don't understand this subject particularly well, or they haven't quite grappled with the systems and processes that will allow them to attribute sales accurately. And because they are ultimately the data source, If your data source hasn't quite got it right, then you've got to rely on some assumptions.
Yeah.
But what we found particularly comforting is that when we first ran the model and we saw the outputs, it pretty much reflected the direction of travel that we've seen in rental values.
Yeah.
Now, of course, the number, if you take fashion and prime city centres, it might not be 34, it might be 40, it might be 20, but directionally, we think they're about a third more valuable. So there's a bit of we applied some checks and balances, and we think broadly the numbers are in the right area.
Yeah.
In terms of how we use this to manage our business, we already do it in a qualitative manner. We're moving towards a customer orientation. We're trying to position our centres to what the retailers want, which is of course ultimately what the consumer wants. I think this accelerates the death of the turnover lease in all but very few examples. I mean, you'll probably be thinking now about value retail. I'm not too concerned about that business because of the special nature of the product, using Martin's example of Made.com. If you want a genuine discounted designer outlet in a high quality environment, you can't really get it online. So I'm not too worried about value retail, but on the average, I don't think this bodes well for turnover rents, and that's certainly something that we're thinking about. And yes, I think we will, and hopefully there's no retailers on the line, but I think we will use this research in some of our negotiations and just see what response we get.
Yeah. I mean, it strikes me that the UK is one of the few markets where you don't get as much data as perhaps you might do on turnover from all your stores as perhaps in continental Europe. Is that true?
Yeah, I mean it's written into our French leases that the retailers have to provide audited sales data,
which is very similar to other sort of continental European retailers. Is there any prospect for that changing? Because it strikes me that that as a property owner, that is starting to actually see what's going on in each of the stores is almost the first step before you can start to build on the complications of this approach, right?
Funnily enough, Chris, I take the opposite view. I think sales data is completely irrelevant now.
Right.
And I'll exaggerate to make the point, but it wouldn't concern me at all if we never published positive sales growth out of any of our portfolios, because, as you well know, sales data is a bit flaky at best. It relies on disclosure, which in some instances is voluntary. It can be completely distorted by a product launch at Apple or a particularly good seasonal sale at John Lewis. I mean, they can distort the numbers enormously. And actually, what I think this paper hopefully goes some way to prove is that I think the disconnect between sales and rents, in both directions, positive and negative, is likely to increase. Because, take the example of Lululemon, their physical sales can increase 20%, assuming the numbers are right, yet the productivity of that store increases over 30%. And I think there are other product categories where that delta will be even greater, and I think the future for some of the retail locations that we identify to be less successful looks pretty bleak. So I think our approach actually as property owners is now less about sales and more about venue management, events, digital engagement, tenant mix, trend spotting, all the sorts of skills that perhaps don't come naturally to property owners, but that we're working hard to bring into the business. OCRs, I mean, perhaps they're largely irrelevant now.
Yeah. Okay, thank you.
Thank you. As a reminder, to ask a question at this time, please press star 1. We will now take our next question from Michael Burt from Exane BNP Paribas. Please go ahead.
Morning, guys. Thanks very much for the report. Sort of very clear on your comments around sort of the falling relevance of sales densities, rent to sales ratios, occupancy cost ratios. I was just wondering, in the sort of interviews you did with retailers, if you've seen alternatives being used to try and measure affordability going forwards.
Well, as I say, I don't think retailers have really got their heads around this yet. So I think it's going to take some time for retailers to move away from sales as a benchmark completely, particularly for those retailers that have been on the high street for a long time. Because John Lewis, Marks and Spencer's, Topshop, whoever it may be, it's kind of in their DNA to take a sales-first approach. When you talk to the new retailers that are entering the market, Tesla at Brent Cross would be a good example, or Nespresso, or some of the pop-up stores. They really, they talk about brand, they talk about marketing reach, they talk about profile as much as they do sales. So I don't think we've yet found a new instrument to replace tenant sales. I think it will probably take some time for established retailers to get their head around that shift. But let me give you an example. Well, I can give you an example actually. You'll know the houseoffraser.com store in Union Square.
Yep.
They have been trading broadly in line with budget, maybe up, maybe down. But what they did about 18-24 months ago is they had an option to break their lease. They chose not to take it, even though not taking their break option was connected to a 40% rise in rent. So they chose to stay in that location, increase their rent by 40%, even though they weren't trading 40% better than they thought they should, simply because they knew that it was the only way that they could address that northeastern part of the Scottish catchment. So that really, I think, is one anecdote that demonstrates that actually retailers are prepared to pay up for the best space, and best can mean many different things to many different retailers, but they're prepared to pay up for the most appropriate space, even if at the headline level it disconnects to sales. I don't know, it's going to be interesting to see how, what tools and techniques they use to measure that going forward, but I think it'll take some time for them to move away from sales completely. Martin, have you got any experience?
I can think of an example of a major sportswear retailer that, when opening large flagships in core cities, rather than looking purely at the rent sales ratio or the sales achieved just in that store, they take the aggregate of in-store sales, sales at wholesale distributors, and sales online, and a portion uplift from across a wide catchment. I think it's up to 50 kilometres to that one unit. So whilst the sale may take place in another town, they attribute the uplift or that incremental rise back to the opening of this flagship. So I think that when we're talking about a world of flagships with full range, retailers look across the whole catchment and then see, as Sam was saying, that the store is almost like a marketing tool in order to really build brand, build presence, and aid the discovery of their products.
Got you. Thanks very much for that, guys. I just have one other question. I just wanted to check on the two case studies you gave us. If I look at the in-store sales pre-multi-channel, and then I look at the in-store sales post-multi-channel, is that effectively just what you think the growth in sales has been for the retailer between, say, 2005 and 2014? Am I understanding that right?
No, we've stripped out all inflationary impacts. These are aiming to purely compare the impact of multi-channel, so the pre-multi-channel and multi-channel environments. So in the example of the food store, for example, around 10% of sales has shifted online. So we've reduced that sales total in-store by that amount. Similarly with the central London example, Lululemon, from the work that we do at CBRE, we're seeing this greater concentration of shopper visits in the best centres, and so we've upweighted the turnover expectation for that location based on the phenomenon such as web rooming, where it really encourages people to visit and spend in the best locations.
Got you. Thanks very much, guys.
Thank you. There are no further questions in the queue at this time.
Okay, well, I think we're moving close to 10 o'clock, so we'll conclude the call there. Thanks very much for your comments, Martin. Thank you again, and Simon. And have a good day, everyone.
That will conclude today's conference call. Thank you for your participation, ladies and gentlemen. You may now disconnect.